Welcome back. So we're kicking off the new year with a market that is just completely split down the middle. We're calling it the Great AI Divide. You've got the companies that build the actual hardware, and they are just soaring. But then you have the software companies, and they are facing a really tough question from investors. Hey, where are the profits?
Okay, so let's just look at the scoreboard from the very first trading day of 2026. Right off the bat, you can see this, split personality. The Dow, which is packed with all those industrial giants, it pushed higher. The S&P 500, it eked out a tiny gain. But the Nasdaq, the heart and soul of the tech world, it actually finished in the red. It's a total market contradiction.
So, what is the real story behind this split decision? Why the stark division right on day one? That's the puzzle we're going to piece together for you right now.
All right, here's the plan. First, we'll dive into the numbers that are driving this whole divergence. Then, we're going to explore that great AI profit divide I mentioned. We'll also look at the surprising new strength in some old-school industries, try to get a read on the market's mood, and then wrap it all up with a potential investor playbook for 2026.
First up, a tale of two markets. Let's get right into the raw numbers and see this divergence in action.
This table pretty much tells the whole story. You can see the Dow was being carried by industrials, by energy stocks. The Nasdaq, meanwhile, was a complete tug of war. You had chip makers trying to pull it up, but big software was dragging it right back down. And the S&P 500? It landed smack in the middle, which perfectly captures a market that is really at a crossroads.
And that crossroads leads us directly to our main theme today, the AI profit-proof divide. The market is sending a really clear signal here, and it's separating the AI hardware makers from the software creators.
It really feels like the era of pure AI hype is coming to an end. After years of excitement, the market's new mantra is brutally simple. Show me the profits. Investors just aren't satisfied with potential anymore. They want actual, tangible proof of profitability.
And if you want to see the hardware side of this story, just look at this number. Wow, a staggering 10.5% gain for Micron Technology in a single day. So why the massive jump? Well, it's because Micron makes the essential memory chips needed for AI data centers, with reports saying their order books are completely full for the entire year. Investors see a super clear path to profit. They're basically selling the picks and shovels in this AI gold rush.
But on the software side of that divide, it was a completely different story.
A nearly 3% drop for the broader software index. Why? Well, skepticism is really starting to creep in. Rumors were swirling that Microsoft was rethinking its pricing for Copilot, its big AI assistant, and that single piece of news just sent a chill through the entire software sector, raising the billion-dollar question, has anyone actually figured out how to make serious money from AI software yet?
Now, while tech was busy battling itself, another part of the market was quietly gaining a ton of strength, what you might call the real economy, the sectors that make and move actual physical stuff.
The energy sector was the top performer of the day, up over 2%, and this was driven by a few key things. You had some geopolitical tensions causing supply fears, and, this is the interesting part, the massive, and I mean massive, power demand from all these new AI data centers. Plus, investors were clearly moving money out of riskier tech stocks and into real assets that pay out solid dividends.
This trend even has a new nickname on Wall Street, PROSAC, which stands for Production for Security. It's this whole investment idea focused on domestic production in really critical sectors like energy, manufacturing, and key resources. And this represents a pretty major shift in how investors are thinking.
Okay, so with all these conflicting signals flying around, what is the market's actual mood? Let's see what the experts and the data are telling us.
So in the bullish corner, you've got analysts like Dan Ives. He's calling 2026 the major inflection point for the AI revolution. But notice his key distinction here. He believes the whole rally is going to be led by physical AI, so the hardware and the robotics, not just the software.
But offering a much more cautious take is Barry Bannister. He's looking at all this optimism and seeing it as a warning sign. He's pointing to frothy valuations and the risk that inflation could come roaring back and just spoil the whole party.
And the data itself reflects this exact tension. The Fear and Greed Index is flashing greed, which signals high optimism that, could be bordering on complacency. But at the same time, the VIX, which is the market's fear gauge, is super low, suggesting traders are pretty calm. So we've got this calm surface, but the experts are all debating if there's a storm brewing just underneath.
So, with this really complex picture, How could an investor even try to navigate this market? Well, the day's trading seems to suggest two very different playbooks.
It really just boils down to a choice. The aggressive play is to bet on that physical AI hardware momentum, maybe through a semiconductor ETF like SMH. The risk, of course, is that the profits from all this AI spending get delayed. The more conservative strategy leans into that PROSAC theme, focusing on energy and infrastructure, say through an ETF like XLE. The risk there? A return of inflation. Two very different game plans for 2026.
To pull this all together, maybe the best way to think about today's AI market is to look back at the 19th century railroad boom.
Think about it. For years, we've been in the phase of just laying the tracks, building the AI infrastructure, the chips, the data centers, and that created enormous value. But now, the tracks are basically built, so the market's focus is shifting to the trains, the actual AI applications themselves, and it's asking a really simple question. Which one of these trains is actually going to be profitable?
It really feels like the initial AI gold rush is over. We're now in the AI railroad era, where the entire focus is on building profitable businesses on top of this new infrastructure. So the big question for 2026 is, which ticket will you buy? A ticket for the companies laying the tracks, or a ticket for the trains themselves?